I'm Peter Gelman with Palmerston Group Advisors. I discussed why the risk of long-term care is so significant in retirement planning in a different video. The essence is that many married couples will face 5 or 10 or more person years of long-term care expenses, and that represents a huge threat to their finances. Today, I want to discuss some things to consider about long-term care insurance when so many of the product offerings are so mediocre and probably aren't a good choice for many people who'd like to get coverage. The essence of the problem is this: insurance companies must guess what future long-term care will cost, and that future is 20 or more years away. Life expectancy, especially for health-conscious Americans, is growing, but so is the cost of healthcare, especially for people in their 70s, 80s, and 90s. When auto insurance companies cover your car, they know what it will cost to repair or replace your car in the event of an accident. The time horizon of that policy is 12 months, and the insurance company can estimate that risk quite precisely and underwrite your policy. In long-term care insurance, the time horizon is 20 years or more in the future. Guess what? Guessing accurately about health costs 20 years from now is hard to do. Lots of insurance companies, which once offered long-term care, have chosen to get out of the business entirely. And the story gets worse from there. The premiums consumers have to pay are supposed to remain level year after year. Often, it hasn't worked out that way. Even though premium increases aren't supposed to happen, and they need to be approved by government, steep increases nevertheless have happened repeatedly over the years, usually 10 or 15 years later, when people are in their 70s or older, retired, and living off their investments and Social Security. In other words, when they can't afford those price increases is when those price increases happen. This also is a casualty of bad guessing 20 years earlier by the underwriters. To top it all off, most of these policies have caps on the length of time you can draw. Most are around 3 years, some for 5 years, and some shorter term policies for around 1 year. And there's a limit on monetary claims too. So what to do? As you explore the market, first, look for products that offer ongoing benefits with no time limit. The critical problem, remember, is 5 or 10 or more per person years of long-term care expenses. Most products have time limits on what you can claim, but some offer the option of paying for perpetual coverage. Second, look for cost of living protection. Most people buy this insurance for 20 years or 30 years in the future. Cost of living escalators can help protect the purchasing power of this benefit. Third, see if you can find a policy that allows a number of fixed, unchanged level premiums. 5 premiums over 5 years, 10, whatever, some finite number with the benefits guaranteed and not subject to future premium increases. And then you're done. Again, be sure it's something that eliminates future premium increases. Fourth and finally, as you create a short list of possibilities, don't overlook life insurance as a possible vehicle to get benefits similar, if not identical, to long-term care insurance. Be prepared to expect trade-offs if you go this route. The death benefit may not be that great, or sometimes the offering is for chronic care rather than long-term care. There will be trade-offs, so keep your eyes open. But it may represent a workable substitute strategy, especially if the long-term care insurance product choices are otherwise unappealing. Thanks for watching.